Hello and welcome everyone to today's session. So as a part of our JPM Employer Talk series on demystifying quants in association with WIT, we have our second session today. I'm Nikita. I have been a part of the JPMorgan quantitative research team in Mumbai for the last 4.5 years. I'm currently a part of a cross-asset platform development team. I had started as an intern and I have now been in the firm for about 4 years, right? So building on to our introductory talk that we had last week, where we had Devashish and Deepthi, who essentially told us about what a day in the life of a quant entails. Today's session would essentially be focused on an overview on derivatives modeling and market risk teams within QR Mumbai. So without further ado, I would like to introduce our guest speakers for today. We have Abhishek Shekhar. So Abhishek Shekhar is an executive director with JPMorgan. He heads the equities and the rates modeling group for quantitative research teams in Mumbai. He has an experience of more than 15 years in the quantitative research field and has worked with multiple well-known organizations in the past, like Bank of America, Lehman Brothers, and Goldman Sachs. He completed his master's in aerospace engineering from Indian Institute of Science and has an MBA from Indian School of Business. Alongside, we also have Trio Pandya. He is an executive director with JPMorgan as well. He leads the market risk quantitative research group for the Mumbai office. He joined JPMorgan in 2019 and has previously worked with risk modeling teams at Nomura and KPMG. He has extensive experience in model building, covering both market and credit risk, market risk regulation, and risk model governance. He is certified in actuarial techniques, finance, and investment from the Institute of Actuaries, UK, and holds a CA degree and was amongst the top 50 rank holders across India. Over to you, Abhishek.
Thanks, everyone. So thanks for giving me this opportunity to talk to you all, and in the second series of Demystifying Quant that JPMorgan is doing together with WIT. And as Nikita was just telling, that I've invested quite a good amount of my professional life in this field of quantitative research. But I did not start with this field, and you can very much relate with me when you are where you are right now. So you may not be in this field, but you have done your engineering or you have done your graduation in some numeric discipline, and you're thinking of a quant as another field, or maybe you are not even thinking, but I'm going to introduce you to the field of quant. Partly that has been done in the last series, but today I'll take you a little bit more deeper in the subject. So maybe we'll talk a little bit about the subject. And I'll try to keep it relatively simple, but still, it should give you a good flavor of what a conventional derivatives quant would be doing. Though the word quant is now split in many different areas. So some are like pure mathematical quants, some are more of infrastructure heavy quants. But whatever kind of quant you are, there would be a good amount of mathematics involved. That can be very involved mathematics, or that can be relatively not that difficult, but still, you are supposed to be good at it and understand it and present it in a well-suited way. So if you ask me, what does a quant entail? Quant research entails. I'll say that it basically has three pillars. One pillar is that you must be good at programming. You must understand programming concept, because a lot of time you will invest in this role, either writing your own code or looking into someone else's code and enhancing it, or looking at your own code you might have done some 5 years back and enhancing it further from there, bug fixing, making changes to the code to adapt to the new market conditions, all those things. So very, very good proficient at programming. That is one thing that we need people to understand. It happens that many people who join us do not join with any programming background, but we give them internal training and they pick up from there and they become like a very good programmer, and they have to be on the cutting edge of technology all the time to be actually doing justice to the role they are in. Then the second aspect of it is, as we discussed, is mathematics. So you are actually studying randomness. So whenever you are doing anything in derivative modeling, you are actually trying to harness the randomness, trying to get some pattern out of it and leveraging it for the purpose you want it to use for. And that requires that you are very good with probability and statistics, you are good with the linear algebra, differential equations, and almost all fields of maths that you actually do in your undergrad, and a few fields which you don't do in your undergrad unless you take some special courses. Again, what we expect people to have is like a good open mind, and a lot of trainings have internally which actually get you to that, if you have a good foundation. And the third thing is understanding the financial products. So ultimately, what you're doing, you are actually modeling the complex financial product in one way, which is a mathematical model. Because unless you have a mathematical model, you cannot answer a lot of questions like what if analysis, a lot of what if analysis, a lot of analysis which is telling you the sensitivity of that financial product. You cannot say a lot about that. So you need to model your actual physical contract in a mathematical framework so that you can play with it. So you can see how it is sensitive to different market factors and take actions accordingly. So those are basically the models, and when we call modeling, we basically mean that. So with that as a background, let me take you to a couple of examples, and these are actually relatively vanilla examples, but still, I mean, they give you a good flavor of what kind of problems you see in this field. So yeah, Nikita, if we can go to the second slide. Yeah, so there are some simple examples of the type of products you kind of trade with your counterparties or with exchange and all. So it's just I'm trying to give you a flavor of, and some of you may know these contracts, some of you might be trading a bit, so you know what a call option is, or you know what a forward contract is, but many of you may not have heard it. I even joined after 5 years of working in different industry. First time when I joined in the finance industry, I did not know any of this. So I started like a fresher in this industry. So many people would be like that, because if they are not investing themselves, they will not hear a lot about these things. So let's talk about the most simple contract, and which has historically also been like there for at least 2000 years. Which is called a forward contract, which you also know in Hindi as Wada Bazaar. And that is nothing but you enter into a contract with someone else that at a future time, T, let's say capital T is a future time, you will buy 1 unit of some underlying by paying something on that day. That paying something is called the strike. So let's say here we are talking about that underlying can be a FTSE stock. So the example here is the FTSE stock. So you are saying that 1 unit of that index you will buy from someone by paying K dollars or K pounds on that particular day. So this is like binding on both of you. You have to buy on that day, and if you are entered into a contract, it's not like that you have an option. If you want an option to buy, rather where it's not binding for you to go and execute that contract, then that is called a call option. So that is the second contract that is there. So just to understand, I don't want to give the FX example. So let's go back to, let's say Infosys, right? So today Infosys would be around 1700, let's say. So it's trading at 1700. So you can come to me and you can say, okay, let's do a contract. And the contract is that you will buy 1 unit of Infosys from me, not now, maybe 1 year down the line, by paying, let's say 1750. So no matter what is the price in the market, I have to deliver you that 1 unit of Infosys stock at a price 1750. But this time you have an option. It's not like you have to come to me. You will come to me only if you want to. And if you are a rational investor, you will come to me only in the situations when the price of Infosys on that day, so 1 year down the line, if the price of that in market is more than 1750, right? So let's say the price on that day is 1800. Then you'll surely come to me and you'll buy that stock from me, and by paying me 1750. And if you want, you can just sell that stock in the market and make a profit of 50 rupees. But on that day, if the price of the stock was 1700, you will never come to me. Why? To buy costly from me. So you will not exercise your option. Your option will go waste. So this is a call option. And similarly, the counterpart is that you can enter into a contract to sell a stock at a particular value on a future date. That is called the put option. Similarly, there is another, so I'll come back to this call option in a second, but I want to introduce a couple of more examples first. So similarly, there is something called a swap. Interest rate swaps are very, very common, and there are hundreds of different flavors of it. But the most common would be that one of the swap leg is a floating leg, and another leg is a fixed leg. So what happens in a swap contract is that there are two counterparties, let's say A and B, and they will enter into a contract, let's say for 5 years, and they will say, okay, for each 3-month period, both of them will exchange some payments. So A will pay B, let's say the fixed amount. So A will pay B 3% interest rate on some agreed notional, let's say $1. So A will keep paying every 3 months 3% to B, and it will keep happening for next 5 years, which means 20 different payments. Whereas B will pay A again on the same notional every 3 months, but he will not pay a fixed rate of 3%. His rate will get determined by whatever was the floating rate that the swap was referring to, and here it is mentioned as LIBOR. So LIBOR is a kind of floating rate. It keep changing every other day depending upon the market supply and demand. So whatever is the rate on that day. So what B will do is that he'll reference to LIBOR. He'll say, okay, wherever is the LIBOR, I'll make my payments according to that. And that's the same thing will continue again for 5 years. Every 3 months, B will make payment to A. And you can understand that if the floating rate goes up, then B is at loss, right? Because they have to pay more and they are receiving less, 3%. But if the floating rate goes down, B is actually at profit. So swap actually is an instrument which lets you convert your risk. So if you have a risk in floating instrument, you can actually convert into fixed risk. And vice versa, if you want to take exposure of floating rate, you can use a swap to enter into a floating rate where you are paying the floating rate. Similarly, there is another contract, which is the fourth one, which is called credit default swap. And this is from a credit world. Here, basically, you say that, let's say there is a bond. So most of the corporates, big corporates issues bond. Also, the sovereigns issue bond. But here we are restricting ourselves to corporate bond because we don't consider in general sovereign to default, but they do default. But let's think of corporate bond only. So let's say Reliance issues some bond, right? So bond is something like you pay 100 rupees today, you get 1 unit of bond. The bond is going to mature, let's say in 10 years. So every 6 months, let's say you get a coupon from bond, which is like an interest. So let's say 2 rupees every 6 months that you get from that bond. And in the end, at the expiry of 10 years, you get your notional also back along with the coupon. So this is a bond. So if as an investor, you go and buy this bond, and this keeps you paying periodic interest. And that's why it's also called fixed income product, because then the coupon that you are going to get is irrespective of the market, it has to be 2%. But it may happen that this Reliance defaults, right? So in that case, the investor money, which was 100 rupees given in the beginning, is at risk, right? Also, the coupons are at risk, but the main risk is the principal that will not come back, or come back only with some recovery of 30, 40, 50, 60%, whatever is the recovery there. So how can an investor who is invested in those bonds can protect himself from that credit risk? So credit default swap is like an insurance on those default of the issuing counterparty, let's say Reliance here, that you enter into a contract with someone like an insurance house or a financial institution who is saying, guaranteeing you that if Reliance will default, we will compensate you for that, and we will make it even for you. We will give you back whatever is the notional or coupon loss you had. We will give it back to you, but they will obviously ask for some price for it, and that price would be something like some periodic premium that you keep paying them till the life of the bond or till the life of the contract. Similar, so that is a CDS contracts. It's traded in huge volumes and very, very popular in the credit world. Lastly, there is another example of a convertible bond. So a convertible bond is again a bond issued by a corporate, but you have an option embedded that if you want, you can convert that back bond to an equity. So equity and bonds are two different way of raising capital by a corporate house, but that they have different entitlements. So equity is like the shareholder is like he has voting rights. So he's like owner of the firm for that percent of the stock. Whereas the bondholder is like the lender. So they have lent some money to the firm. They don't have voting right. They are the lenders. So convertible bond is a mixed instrument. It gives you the option to switch from your bond, you convert your bond to equity. And of course, you will do that when the equity is doing good. You will not do that when the equity is not doing good. So there is an embedded option. So I gave you flavor from a couple of different areas, what kind of vanilla instruments you can see. Maybe we can go deeper into the second one, which is the call option. Try to see it at little closer what problem it has. So Nikita, can we go to the next slide? Yeah. So if you just buy a stock, your payoff is like this straight line, right? So if the stock goes up, your payoff is more. If the stock goes down, your payoff is less. So it's nothing interesting is happening here, but that is your payoff at some time t if you have a stock in your portfolio. Next one. If you buy enter into a forward payoff also, I mean the payoff is still the same like a stock. Of course, it is shifted by the strike amount that you are going to pay, but again it is like the same because there is no optionality. You have to enter into that contract in future instead of today. So that's why your payoff is at capital time t. So S capital T is denoting what is the price of the underlying at time t. So your payoff will be S capital time t minus the strike price, whatever is the strike that is agreed. Again, nothing interesting happening in terms of the payoff itself. Maybe we can move to the next one. Yeah, so this is the payoff of the forward contract. Next one. Yeah, so this is the payoff of a call option. Maybe we can invest one more minute here and try to understand what it is saying. So on the x-axis, you have the price of the stock 1 year down the line. So we entered into a contract of buying Infosys. So let's say the x-axis denotes what is the price of Infosys 1 year down the line. So capital T is 1 year. And K is some strike. So the strike here is on this scale is, let's say, 5. So how is your payoff going to look? So if you have bought this option, so if you have the right to buy this thing by paying 5 to me, and then what is your payoff going to be looking at on maturity? So on your payoff that is going to look at maturity is like a hockey stick graph, right? So if you have the stock ends up less than 5, of course you will not come to me. You can, if you want, you can directly buy from the market. You let your option waste. But if the price is more than 5, you'll go and exercise that option. You'll buy it from me by paying me 5, and whatever is the price in the market, you'll sell at that. So your profit is ST minus K. So so this is the payoff of the call option. Now you can, I pose you to this is the highlight of the talk, that, okay, this contract is there. So you come to me to buy this contract, but why should I sell you this contract for free? Of course not, right? I'm giving you some kind of insurance. So I'll charge you something. I'll ask you that pay me something, compensate me for something, so that I give you this, we enter into this contract. And what should be that premium? What should be that fair price for this contract? And that turns out to be a very, very difficult and mathematically involved problem. In fact, the call options and put options were traded much before than the actual theory of this, of how to price it correctly, came to market. So if you hear Black and Scholes, they were the people, the economics and the mathematician who actually developed this theory based upon the principle of no arbitrage, that how should be the pricing of this should happen. And they got Nobel Prize for this. This is like the most fundamental thing on which most of the derivative pricing is there. So the no arbitrage principle is simply saying that if two things which are different in their structure, but they give you the same financial exposure in all the different types of future events that can happen, if they are same, they should price the same. And that is no arbitrage. And based upon that, we develop the equation for Black-Scholes to price these call options. And it is actually a partial differential equation that you get, that you need to solve to get the price of this. And that using call option to price, when you do any other model, you actually try to make sure that your model is calibrated to these call options prices, because they are the liquid instruments that are traded in the market. So if you come up with a model, mathematical model, which is not pricing these things correctly, then we are not going to use that to price anything more structured or more exotic, which because we'll say that, okay, this does not satisfy the building blocks of our derivatives instrument. So I think I'll take a pause here, and I'll ask Triyog to continue from here. And shall we take the questions after Triyog is done? So I think we'll take the questions once Triyog is done.
Yeah, I'm sorry, I was on mute. Apurva, I think we can keep Abhishek's slide for some time before we come here. Yeah, okay, thank you very much. Yeah, I think we can keep that the call option. Yeah. Okay, so yes, let's talk a little bit more about this the same financial concept which Abhishek highlighted. First of all, Abhishek, thank you for that great insight. It was very important topic Abhishek covered. A few of the things which he highlighted during the initial part. What makes you a good quant? These three aspects which Abhishek highlighted were very important. Very good programming skill, the mathematical understanding, and the product understanding. These three together can make you a very good quant, no matter whether have you ever heard of all this complex financial jargon. Doesn't matter, if you acquire these understandings step by step, you can become a good quant as well. And as Abhishek mentioned, before he started his financial career, even he was not aware, none of us were aware of all this thing. So at the end of the day, all this pricing happens based on a mathematical concept. So if the mathematical concepts are clear, and if we know how to implement those things through a proper programming way, then there is then even the sky is not the limit. Anyone can be a very good quant. So having said this, let's talk about market risk. So I think all of you must have heard this term market risk almost every day. You must be hearing this. If you see these mutual fund ads, they always at the end of the day, after telling you all the nice thing about what all things you can do with your money, at the end of the ad, they always tells you the mutual funds are subject to market risk, right? So they tell you, they give you some slight warning that okay, yes, you should invest, you should put your money here, but you are taking a market risk, right? So it's a very familiar term. Everybody nowadays understands what is market risk. So again, just slightly, if we move out of the financial world, market risk is everywhere. Just to give you a simple example, say if you want to buy some new phone, and you decided that there is some pre-launch is happening, and you have already paid the money for that, right? Because you did all your research, and you found that the pre-launch is giving you the best price. And after you bought the phone from pre-launch, within 7 days, some festival season started, and the price crashed by 20%, right? So you didn't envisage those situation, and then now the same phone which you bought a week back is now trading in the market for 20% discounted price. So that is the market risk, right? Now there are the wherever there is a market risk, there is a risk which needs to be managed. So the concept which I'm going to introduce you today is about the market risk management, like how we can manage the market risk. Now let's take now one example of the financial world. Abhishek mentioned about Infosys. So we have an Infosys stock which is trading every day in the market, right? Now you decided to buy this Infosys stock, and you want to buy some, you want to invest some money in Infosys. Now if you whenever you put your money, the first thought comes into mind. The objective is always to make money out of it, to make profit out of it. But although that is the objective, always a thought will come in your mind that will I lose something here, or how much I will lose something. Yeah. So that is the very obvious question whenever we put our money anywhere, right? So suppose if we are buying an Infosys stock, how to measure the market risk. I have bought a one stock of 1600 rupees. Now, what is my market risk? There are a lot of different methods. One simple method is that uh, you will go into the some site where you see the Infosys price every day, and you will see last 1 year price, and you will see that how the price have moved. Overall, you are comfortable that it was always within the range of 1400 to 1800. So worst case, I will lose 200. I'm okay with that because I want to. I feel it's a good company. I will buy the stock. So now you have taken a decision based on those historical moves, and you decided that okay, 200 is something which I'm fine with. Now when you take that decision, it means you have taken a decision within your risk appetite. Your risk appetite is 200. You have decided that 1600 I will put. My objective is to make profit out of it. It's a good company, I will make profit out of it. But if the stock price goes down, then I'm okay to lose up to 200. I'm fine with that. And I can see in the history the stock never crashed below 200. So that's fine. That's the market risk. But this analysis which you have done is slightly incomplete analysis, right? Because whenever you talk about a market risk, like how much I will lose, uh, one of the very important concept of risk is that you are always and always interested in loss. Profit can be infinite, but right now you are, when we think about market risk, you are thinking about the losses. How much can I lose? Now how much can I lose is a incomplete question, because uh, because you have to add few more parameters to this question. Question one: how much can I lose within X number of days? Right? If you decide to keep Infosys for 5 years compared to if you decide to keep the Infosys for 5 days, they both have a different risk profile. Right? So that is the first question: how much I can lose within X days. The second question, which comes into very important, is that what is the probability of that loss? The market risk is very tightly assigned to the probability. No one can predict what will happen tomorrow to the Infosys price. I can bet you. Put any sophisticated models or any technique or any mathematical models, no one can exactly precisely predict that at what price the Infosys will end tomorrow, right? So it is impossible to predict, right? And that's the reason probability comes into the picture. The probability will not help you in prediction, but it will definitely help you in estimation, that how much the price can move for given period of time. So these two important questions you should always ask when you think from the probability perspective, or from the market risk perspective. What is my time horizon for which I am computing my market risk, and what is my probability under which I am computing my market risk? Now I'll give you one simple example. If I tell you that within next 10 days there is a 5% chance that on this stock you will lose more than 200 rupees of one stock. So now you have to think from your appetite perspective. First of all, we are talking about a 5% probability. So there is a 95% chance that you will not lose more than 200. I'm based on my mathematical model, I'm telling you that this is your loss profile. And then also I'm telling you within how many days you will lose. Once you have this information in with you, you can take a correct decision that okay, am I ready to lose more than 200? The chances of happening that is 5%. If you are a very conservative person, you will say 5% is a too large probability. I cannot take such a large risk because 5% means out of 100 days 5 days such thing can happen. It's too much. So you are a very conservative person, right? So you may not. Now suppose if there is another person who is very aggressive, who wants to make money, he said, and he or she will say that okay, it doesn't matter, 5% is too low probability, 95% chance I will not lose more than 200, and this stock is very good, let me invest. So that is why these two things are very important when it comes to the market risk. Now let's talk a little bit more about the stock. So Apurva, if you can go a little bit on the one slide before this, the slide one slide before this, the previous slide, the previous slide, call the one where we are just showing the straight line. Yeah, this one. Yeah, yeah. Okay, so this is a very interesting slide. If you see, there is nothing fancy here. It's just a simple straight linear line, right? It's just going linearly. But if you carefully observe this slide, on the left hand side, it is stopping at 0 on the x-axis, right? So the x-axis starts from 0, and the right side is actually going infinite. So although it is stopped at 10, you can theoretically go to infinity. So what this particular slide is telling you, that your profit is infinite. If the stock price goes from 10 to 50 to 100 to 1000 to million, you will keep making that money. What is your loss? Your loss will stop when the stock price hits zero, right? So that's your maximum loss. Okay, now this is very interesting mathematical concept. If you have few of you have read about the distribution, this called as a log normal distribution. So what is log normal distribution is your the distribution starts from zero and it goes up to the infinity. So so you never go below zero. That is very important part. Now having said this, there are a lot of market risk variables or lot of market variables which we in past, maybe during our grandfather's day, we never thought that it will go negative, but they are today are going negative. First example is interest rate. You must have read all this thing in the newspaper that Japan, Europe, the interest rates are in negative. What is a negative interest rate? The negative interest rate is if you want to keep money in the bank, you have to pay to the bank. They will not pay you. In India, we have never heard of this concept, right? Where whenever you put a money in the bank, the deposit in the bank, you always get some return from the bank. Bank will say that, okay, I'll give you 5%, 6% or a deposit. If you are keeping in savings account, you get 4%. We never thought of that this can go negative. Like I'm putting a fixed deposit or I'm putting my money in the bank, and bank is actually charging me to keeping my money. So theoretically, it means it's better to keep the physical cash at home compared to keeping it in the bank, right? So this is the interest rate. Like that way, recently during COVID period, I think all of you must have read this news, commodity price. The commodity oil future price, they went into the negative territory. So again, this is something which we never thought of, right? But there are certain kind of an asset class which went into the negative. Now when such thing happens, the modeling team, especially the team where which Abhishek leads, those people, then they have to start think out of the box, because now no, now your traditional traditional pricing model no more works, right? Because you are now entering into a completely a new territory where you never thought of that such thing can also happen. So that's where this pricing becomes very interesting, and that's why the finance is a very very evolving field. Nothing is fixed, and every models are every day evolved. They are made more robust day by day, and that's the reason that's it's important that we understand this concept very well. And similarly, if we go to the next slide, the call option. uh, yeah, again, here also, maybe I think we should go to the put option. Sorry. Yeah, so the put option here also, if you see, the left hand side will stop at zero. So the interesting part about the put option is that if you are selling a put option, so if you are giving a person an option to buy a stock from you for a given price, you already know your maximum loss. What is the highest loss you are going to incur, because the stock price stops at zero. But then if the stock if the price is higher than your the strike price of the option, you will just make the money out of the premium which you got, right? So these are very important concept. I just want to highlight one of the another concept to you, which is called as a value at risk in finance. So sorry, I'm a bit lazy here. I don't have a good fancy slide like Abhishek, but I'm going to show you a simple Wikipedia page. All of you don't have to ask this from me. You can always go to the Google and do a simple Wikipedia search, and you will be able to see it. So I want to introduce this concept of value at risk. This is one of the very very interesting model, and which is used heavily by a lot of financial industry, not only just bank but across every the corporates which are into the financial industry. It can be an insurance company, it can be mutual fund. Very important concept. So what is value at risk? It is exactly the same what how I introduced, right? The market risk concept, the how much we can lose for a given period of time for a given probability. That is the value at risk. So if you see this diagram here, on the left hand side, we have a losses, and on the right hand side we have a profit, and there is a distribution. So the distribution is actually telling you the probability of every points. And if you see the red one, which is the area under the curve highlighted in red, that is the area which we are interested. And the point through which it starts, that's the percentile point of a var, or that's also called as a confidence interval. Like at what confidence level we are computing the VAR. So this is how the VAR is computed, and VAR will tell you exactly how much you will lose for a given period of time for a given probability. Now there are different methods of computing VAR. Now as you can see this diagram, it is a distribution, right? So you can again, let's take this Infosys as an example. Now I want to compute a VAR for Infosys. How I will compute? What is the method I should apply? There are a lot of different methods available. One very simple method and heavily used by everybody is the historical simulation. What is historical simulation? You go to the some public site where you can download the Infosys price, download it for last 2 years or last 3 years, whichever history you have available, and then first identify what is your duration of for which you want to calculate the VAR. If you want to calculate the VAR for 10 days, then take the 10 days return of that historical stock and then sort them in the descending order and decide what is the probability. Say suppose your probability is that 95% is your confidence level, and if you have 1,000 points, then the 5% of 1,000, which is 50, so you take the 50th largest loss amongst that time series, that becomes your VAR. That is as simple as this. Although there are a lot of fancy statistical methods available, but this is the one which method I explained you. That is the simplest way of and the easiest way and the heavily used method by everybody in the industry is called a historical simulation. Just pick up the history, take the snapshot of the confidence level at which you want to stop, and see what is the loss you are incurring. That loss becomes your VAR. Now there are as I mentioned, there are some other method, like if you are a good quant, then you don't want to just rely on the history, right? Because history never repeats. There are things which happens like history but not exactly like history, right? So you want to see that, okay, I don't want to bias my VAR calculation just with the history available to me. I want to build my own model. So that is called as a Monte Carlo simulation. So where what you will do is that you will looking at the history, you will decide, okay, what is the distribution of this price, how the prices are have moved, and you will apply that distribution into a simulation. You will build your own simulation. We don't have time to discuss that, but this is very very important. I want to introduce this concept called Monte Carlo simulation for VAR. Please do reading about it. It's a very very interesting mathematical approach through which you can generate the VAR with a scenarios which never happened in past, but just by tweaking some of the parameters of your distribution, thus by changing the assumptions of your distribution. Now why VAR is so powerful tool? If it is so simple, why it is there are so many literatures and documents and all those things are written there? Because what we discussed here is we just spoke about one simple Infosys stock. Now just imagine that a very large bank is taking exposure into the millions and millions of stocks. Abhishek highlighted a lot of different asset classes, right? You have a credit spread, you have an interest rate, you have FX, you have commodities. Like there are so many different variables moving randomly here and there, right? So you eventually want to compute your value at risk at a portfolio level, right? So you want to compute the entire portfolio level VAR, and that's where this modeling technique becomes very important. How you simulate different risk factors together, what are the assumptions you take, how you handle the correlations between them, how you identify the systematic risk out of it. So these are some of the concepts which are very very important. This is a very nice page, although wiki is like publicly available, but I think if you have not read this, read this. It has also given some very good references to the certain books which you need to go through to compute the VAR. There are we already spoke about the methods of VAR. There are also approaches of VAR. If we take the call option and put option, which Abhishek highlighted, those option prices or those equations can be differentiated, and based on that the Greeks can be computed. Again, I will encourage you to read about what is option Greeks, like what is delta, what is vega, what is gamma, and how that can be used to compute the VAR. These are very basic concepts, but very interesting concept to get introduced to the to market risk. So these are few things I wanted to highlight. And also one more thing before we close this session is that, well, there are when you look at the history, you also have to look the history which is beyond say your assumption. Like for example, you have taken the last 3 years of time series, right? Think about 2008, 2009, or think about 2012. What happened at that time? See how Infosys behaved at that time, or how this company behaved at that time, because there are certain crises happened in the history. So you also want to see how the my VAR will change if I take those crisis period into consideration while modeling my VAR. Similarly, COVID is also one of the crises. Lot of markets have changed drastically. You must have seen BSE Sensex, it dropped to 23,000 just a year back. Literally year back it was 23,000. Today is at 55,000, right? Why it crashed to 23,000? Because of COVID. The COVID struck India in March, and the market crashed, right? So these are some of the stress events also you need to incorporate while computing the value at risk. So yeah, I have introduced few of the concepts. We can talk about this for endless time, but I do encourage all of you to read about this. There are certain book reference also given by Nikita and Apurva. Please do read, do invest in such books. They are very good books, and they can definitely introduce very good concept both on the pricing side as well as on the risk side. So yeah, I think I'll stop here. Maybe we need 20 minutes for a Q&A session as well.
Right. So thank you, Abhishek and Trio, for this insightful peek into, what are the technical aspects of a role when you work as a quant for a bank, right? So now we would basically like to take some questions from the audience. The one before, we dwell into more technical and more sophisticated questions, there's like this one question that has been going on around for a while, which is, how do you get started? How does somebody from a non-banking background get started? Uh, I can see from the comment section that people feel a little bit lost. People are asking for, links or tools that they could refer to get their journey started. So, what is some of the books or, some of the sources or courses that you would take and that you would suggest people to take to get started uh, into the quant world?
So yeah, so let me start, and Theo, you can add more things to it. So what comes to my mind, let me say first. So first thing is that we assume you are at a certain level of let's say you have done your engineering or any graduation in math or science or post graduation or a PhD in any of these numerate discipline. So you have a basic understanding of usual math that we use up to graduation level, and you have a good amount of coding. You understand coding, or you have an interest in coding to understand it. So if we start with that premise, what do you need to do? So of course you need to, you want to go in a structural way, then there are many courses that you can do. And then that is a very, very structural way. You let them run the course and you will know everything that is needed. For example, one of the course would be CQF. That is a course which you can do, and it is very much aligned to what a quant researcher or a quant needs to do. Another course could be you can do specialization in financial engineering, which is generally after graduation you can do that 1 year course from somewhere. So, and similarly, there are many other courses that you can do. You can try doing FRM, which is very, very relevant to what what Theo was talking about. So, and like that, there are 5, 6 different courses you can do, but that's not necessary. What you can do also is you can do your own self-study, right? And you can get interested in this. You get some good books, you get some good websites, and from there you see that what you know and what you don't know, and where to start. So depending upon where you are in your career. So let's say you have invested 3, 4 years in tech, or maybe you are even fresher than that, so 1, 2 years in the tech world. So you've seen the technology aspect. Now you don't know what does the quant finance entail. So start reading on your own from the books, from the resources on internet and all, and you can build some amount of good understanding. And that is what is expected. I mean, when you go to an interview or somewhere, if you're not coming with a field which is actually the same field where of quant research, we don't expect you to understand that, okay, the nitty-gritties of it. If you have a good high-level understanding and a good background, that's most often enough. But if you are more experienced than that, we would expect that you know your domain much better, and you have the capability to leverage that to by quant research. So that is what I would say. Trio, you want to add anything?
Yeah, I completely I agree with Abhishek that you may not need to do the courses. There are sources available. There are book references which we have given. And yes, also one of the important point is that if you are already experienced, if you in some of the role, like for example, if you are a programmer or if you are already doing some development activity, then just try to see that, okay, how I can integrate that with this additional knowledge, right? For example, a call option, it's a very simple thing. You try to build a simple pricing for this using the some of the Python codes, or you will get those literature as well in the internet. So these are few things which you can definitely start with. Let's start with what you are already doing and then build on this. That is important. Sometimes this courses gives you some structure, like for example FRM or PRM. Like if you want to know, okay, risk, there are so many concepts, like there are so many pages on VAR, and what is financial product, what is swap, where should I start. Sometimes this courses gives you some structure that, okay, this is how it starts. There is a level one. They introduce some financial concept, so they definitely help you. But yes, as Abhishek mentioned, it's not mandatory. Like we have so many in our risk team, they are not FRM certified, PRM certified, but they are very powerful in risk modeling, right? So yeah, that is what even I will suggest.
I absolutely actually agree with both of them. So I came in from an engineering background with not much knowledge about financial products. And I think like referring to books has been the biggest thing that I would advise to people. For somebody who does not understand derivatives at all, I would suggest Option Futures and Other Derivatives by John C. Hull. It is a very, very basic book. It actually speaks about the products right from the base. It assumes that you have absolutely no knowledge of finance, right? So that would be a very, very great book to start out with. Uh, Apurva, my colleague, has actually suggested a lot of really good, sophisticated books on finance. We'll also share these in the description of the video. She's also mentioned a few certifications that can be useful. Again, these certifications, like Abhishek and Triyok have mentioned, are not mandatory. And that when we are actually looking or reviewing a candidate, we do take into consideration about your background and the field that you come from. And as long as you have, technical coding skills, as well as you have like good mathematical skills. I think the training in terms of quant is something that we do within the team as well. So we have like a quant training program that runs every year. We just finished it last week for this year, and that kind of helps you get started into the quant world as well. Moving on to the more technical question. So we have a question which is so who can use convertible bonds? Abhishek, would you like to take this?
Yeah, so convertible bonds are actually very, very good instrument both for the corporate people and the investor. So let's say that I will have a hypothetical scenario that you start a company, the company is now a good mid-sized company, and you want to expand it further, you want to raise capital. So you can take loan to raise capital, or you can issue fresh shares to raise capital. Convertible bond is the best of both mix. So you can also issue convertible bond. Now, when you issue convertible bond, what happens is that the investor who is going to invest into it, he may think, okay, it's a startup company or not a very seasoned company. I should have the first right on the capital. If the company does not do good, I should get back my money as the first right holder. So they buy this convertible bond, which makes them someone like a bond holder who has like the lenders to the company. Company is the debtor, and they have the first right on the capital when if the company defaults or something. But on the other hand, they don't want to lose the upside. So it can happen that the interest rate go down or the firm starts doing very, very well. So in that scenario, they would like to convert their bond into equity. So maybe 3 years down the line, they will now see, okay, the firm is doing good, and each bond can give them 3 equities, which is much more in market value compared to what the market value of the bond is, a usual plain bond is. So they can decide to exercise. So it's a very good signaling from the corporate as well. It's a very good protection from the investor, and the investor can be anyone. It can be a retail investor, it can be another financial institution, it can be anyone. I mean, it can be a pension fund, a college education fund. Anyone can be. It's like a bond with an embedded optionality.
Right. Moving on to another question. So, in which scenario do are forward payoff contracts useful?
Maybe Abhishek. I think this question is for Abhishek. Maybe I'll let Abhishek to answer.
Okay. Yes, forward payoff is something like it gives you an option to either take the ownership of the underlying today itself, or maybe you want to take it in future. Uh, but it is all about taking the ownership of the stock if you are buying that if you're on the long side of the contract. And there can be many scenarios on which can actually ask you to go for a forward contract. One can be pure betting itself, right? So, given the current market scenario and the current spot, there is a forward level which the market is expecting, but you think that no, the market is not pricing it correctly. Maybe the forward price should be much more than this. So you can go long this contract and you can bet on this scenario which you think is the right. So that is one betting aspect. But other than betting, you can use the same contract to hedge something, right? So to risk manage yourself. So suppose you have to give that stock to someone in future, right? Or you are exposed to the risk of that stock you have sorted. So you can use that forward contract again to mitigate your risk today, because if you have to give that stock someone to in future, you can enter into the forward contract today, lock into a price today, and you are then not worrying about how the market will change when I have to actually deliver back the stock to someone back. So depending upon what your concern is, if you want to take a bet, it's for that. If you want to go long on a stock in future, it's for that. Or if you want to hedge your risk, it's for that.
Okay. Thanks. So sorry, Apurva. I can see one very interesting question. Can I pick it up? Yeah. Okay. So there is a question called when the market collapses suddenly, how the data model theory is reacts, predict, and change. Very good question. If we again look from the value at risk concept, right? So value at risk, what we are doing is that we are trying to estimate something what will happen in future, right? But as I mentioned, we cannot predict the future, and that's why there is a very important concept in value at risk called as a backtesting. Like we have to do a backtesting of all our models, and what is backtesting? Is where we can compare what is predicted or estimated by value at risk versus the real market, how the market change. Now if the market is has changed significantly, then you may incur a losses which are beyond estimated by var for more than the probability for which you estimated. Like for example, if a very simple example of if my var is 1%, then I expect my losses to go beyond var only 1% of time in out of so if I do 100, maximum it should go beyond only one time. Now it is breaching, if the real market is breaching my var estimation for more than one, it is breaching 5 6 times, then definitely there is some problem in the way we are building the var model. So this back testing is important. The market collapse or the sudden increase in the volatility of the market helps us to identify how the robust our models are, and accordingly we have to change the estimations, the parameters of the model, and make it more robust. So yes, very good question, and please do read also about the backtesting process for var. That will give you some insight on that.
There's another question that I see, which is, what are some of the most challenging derivative instruments in terms of both modeling and pricing? And probably I'll add in terms of risk management as well.
Okay, so maybe, okay, sorry. Abhishek, I'll just take 30 seconds, then I will hand over to Abhishek. Abhishek is expert in this area, but I can tell you it is infinity. Like there is no limit to the complexity. Like it about, just think about a mathematician who can think of any complex instrument. So I can tell you there are no restrictions in terms of in fact you can build your own derivative instrument if you want. Like Abhishek has introduced you a call option. Now think of some more features and you can come with some product which is not even traded in the market. So there is no limit to it, but maybe Abhishek can add some more on this. Yeah.
Yeah, thanks, Priyog. Yeah, so there are different kind of complexities. So Priyog talked mostly about the complexity which is in the structure of the product itself. So the product can have 10 different features which are very difficult to model or understand. Uh, so that is one level of complexity. But the real complexity is when you have a product and the market is not very liquid. So if the market is not very liquid in the underlying instruments or in the instruments with which you can actually risk manage that instrument, because the way we price things in derivatives world is that we always see some kind of synthesis of a complex instrument in terms of the simple vanilla counterpart. So we can all the no arbitrage pricing is actually that somehow you are taking the very complex instrument in terms of liquidly traded instruments which are very vanilla kind of instruments. And if that market does not exist, if that market is broken and all, that creates number of problems in pricing. You have sometimes you're pricing an unknown, but that is one kind of complexity. Product complexity itself is one kind. Then there can be some complexity because of the numerical procedure you are going to use for that model. Maybe there is no closed form formula for most of the things. There is no closed form formula, and maybe when you do some numerical technique, it poses other kind of difficulties in modeling. So it can come from there. But if you can think of, I mean, if you just want to hear some name, I can say something like YCSO, for example. It's one of the product. Let's say callable inverter floaters, another product, which are like or Bermudan options, embedded Bermudan options in many of the swaps and all. So these are difficult products because by construction, not by how to price it. It makes it difficult, but not necessarily from that perspective. And then there can be a third kind of complexity, is it on the underlying itself? What is on the underlying on which you have the option? You can have option on anything, as Priyog mentioned, right? You can have option on even there are options which are traded on weather, options which are traded on earthquake, right? It's very, very difficult to model those things. But I mean, the underlying itself is producing a lot of things. These days, the most common things are most of the things like Bitcoins. Right? So you have options on Bitcoins and options on Ethereum, things like that. So there is, I mean, this is still evolving, where the underlying itself is very volatile, and then these options are actually evolving in market, and people are talking about that and trading that. So here the underlying makes it more complex than the option itself.
Agreed, agreed. We have another question. So, how may we study global markets for insights into markets of particular countries, basically, based on global market cues, that is?
Yeah. Yogi, you want to take it?
Yeah, I'm still analyzing the question. How may we study the global market for insights into the market of a particular country as per the global market
Cues.
question cues? Okay, or as per the global market cues. Okay, so yeah, there are different ways of studying the global market, but I think the first thing I want to introduce is that please do read the financial newspaper. Like that is very important. Like the Economics Times or the Financial Express, it is very important. No matter in which field you are, you should always read this business newspaper. That will give you definitely some of the good insights in terms of the this global market event. So or the market event specific to your country. Also, the second thing, although it you may not come across those things, but sometimes in this financial paper they also highlight some of the rules and the regulations which governments are building. And sometimes they build this because to react to the global market situation, like for example a crisis in a oil market. So how the Indian government is reacting to that, what are the policies they are forming? These are some of the things which you can read about it, and then that can give you some insight of that, okay, how the overall global market is working on. So these are few things you can definitely look into. Maybe Abhishek, you want to add more here?
Yeah, and maybe the macro indicators, right? So the macro indicators are what is the inflation of the firm of the country, what is the interest rate of the country, how it looks to the interest rate globally, how is the exchange rate looking for the country, what about inflation, unemployment. So those data, if you have a good idea about those data, at least for the developed world thing, then you can compare against those and see which way it will go. So one very simple thing would be like, let's say one country A has interest rate 10%, and let's say US has interest rate 1%. What will happen to FX, right? So that you know that the exchange rate of that country will um, uh, it will deteriorate from whatever it is because there is again the no arbitrage of financial equivalence of exchange rate, and you can make it this prediction very easily from looking at the exchange rates of the two different interest rate of the two different countries.
Right. We have one more question. I'm not clearly sure I understand, but from what I understand, I think the question is around, how do we manage between the differences in the predicted losses and the actual losses that eventually are incurred?
Okay. So yeah, as I said, first of all, there is no prediction here. It's an estimation. So we can only do the estimation. I will encourage you never use the word prediction. Nobody can predict the future. It is an estimation. An estimation is a statistical word, right? So yes, whenever we estimate certain losses, they are associated with the probability. When the real event happens, that's a real event in front of you, right? So there is no probability associated with him. So that is a very big difference. Like you are comparing the reality with an estimation which is attached to the probability. Now you can bring these two together by doing some comparison, right? Like historically, since last 100 days, you have estimated this much of losses, and what were the real losses? When you compare this, you can realize that what is the accuracy of your modeling. Now I want to highlight one thing. I can see that there is a follow-up question on this, that suppose if we are already doing a modeling and there is a crash, how the modeling will react to it. So I want to highlight that we like in a banking situation or a financial world, you don't have always one model to handle everything. There are so many different things. There is a process called as a stress testing scenario analysis, where there are certain hypothetical stresses are applied on your portfolio just to understand how the portfolio will behave. For example, like the entire market crashed by 40%. You will never see such situation in the past, but you are applying this just to understand that okay, how much the losses the bank can incur. So that is called as a stress testing. There is also a process called as a scenario analysis, where you come up with a lot of scenarios, and those scenarios are contributed by people who are expert in their field. For example, we can go to economists and understand that okay, how the market will behave if the oil price crashes. So then the economists can help us and come up with some scenarios which we can use to estimate such losses in the future. So yeah, that's
Okay, we have one last question. What is a programming language which is suitable, or I'm assuming most used by quants?
Yeah, I mean, depending upon the firm, that can change. But one thing which you see very common in many firms is the core engine. I mean, many times is a C++ or C-based engine, but these are like old engines where people have been coding for last 10, 15, 20 years. But over the period, there are many different programming languages which are used. They can interact with the code. So, if we are talking about JPM, of course, the core, one of the biggest libraries in C++, but then equally big or maybe bigger library than that is in Python. It interacts with the code, but that library is in Python. But there are many other libraries where we use different language. For example, there is a one booking system which used a language which was a functional language when Java was at its budding stage. It's called Scala. Many people use Java for many of the things, for many kind of programming. Depending upon which project you are looking at, you have one or the other programming language that you will use, and it doesn't matter a lot many times. Because if you have good programming concept in one programming language, you can very easily translate it to any other programming language. So you don't, I mean, even when you interview people and when we hire people, we are not very specific about we must know this language. As long as they have good software principles and understanding of programming in general, independent of the language, it's fine with us.
So with this, we would like to basically wrap up today's session. Thanks a lot, Abhishek and Trio, for all your guidance, for your help with this. And thanks everybody for joining. Also, please don't forget to fill out the feedback form. It is available in the description link. In addition to this, we will also add in more information about the different resources that you can use, the different courses that you can refer to, the different books that you could use to get started onto the quant space or to actually get into at a little bit more advanced level. So please do check out the description for this video later. Yeah.
Thanks a lot.
Thank you, everybody.
Thank you very much.